On this episode of the Stock Market Playbook, we are joined by JC Parets from Trend Labs, Stock Market TV. He's got some wild takes on where he sees the next opportunity happening, how he approaches the market, and what kind of extremes he looks for when he's taking some trades. Stay tuned. You're going to love his take on the stock market. Okay, guys, welcome back to another episode of the Stock Market Playbook. We are lucky enough to have Mr. JC Parets with us here today, and we got some cool stuff we're going to talk about. So I'm excited to have you. Thanks for being on the podcast with us.
Happy to do it. This is great. This is always fun. Love it.
It is. It's luckily the stock market never runs out of things for us to talk about. So it's not like there's any dead topics. What so tell me a little bit about yourself. I'm just coming across you, very recently. I've seen some of your episodes, and you're really a big chartist. So tell me a little bit about your background and how you got to where you are.
Sure. First, to lean in on your point about, there's always something to talk about. I've been blogging every day for 16 years, something like that. And even, writing before that, just to an email list, probably since like '08. So like 18 years of writing, like, very consistently. And, to your point about, there's always something to talk about. That is true. That is very true. And like, not really these days, but like I've had some times where I'm like, well, what am I going to write about today? And then I would just start looking through charts, and like within minutes, it's like I have so many things to talk about. It's a joke, right? So, this is not, it's not hard to find material in the market. The game's never over, right? It's just, you go to the next quarter. Now it's the fifth quarter, sixth quarter, seventh quarter, right? You just keep going forever. So there's no
It's an
ending, which
eternal game. Yeah.
for sure, which psychologically for, humans, it's hard for us to be able, because there's everything in our lives has a beginning and an end, and like this doesn't, just goes on forever. And now you got 24 markets, like, so it doesn't stop. So, it's important for us to understand that and then adapt our behavior and, purposely take time off, go to Mexico, go to whatever, Spain, go, and you don't have to go anywhere. Just stay out of your office. Don't open your computer. Like, go to the zoo. It doesn't matter. Just get away. And, short stints, longer stints, do it. And then there's long weekends and ways to make it easier and stuff like that. And if you have a family and you're busy as it is, then it's really easy to do. So anyway, I just think it's important. And that's, you're asking me a little bit about myself and everything. Over the years, that's been really the biggest thing for me is understanding human behavior and
For
understanding
sure.
that humans make very irrational decisions under stressful conditions, and in the market, the conditions become stressful because there's money involved. So it really brings out our true lizard brains, this irrational behavior, and you can understand that it serves two purposes. Number one, it helps stop you from making those irrational decisions, which is great, right? We're not here to be the smartest people in the world. I know I'm not. We just have to be slightly less stupid than everybody else. And that lack of stupidity really compounds over time. I can tell you, I promise you. So it's understanding our own flaws, not acting upon our emotions, and then recognizing the flaws that the other people have the same flaws as me, right? We're all humans. We're all built the same, our lizard brains. And then being able to recognize that they do not have the ability to overcome those emotions. And in most cases, they don't even know that they're having the emotions in the first place. and being able to recognize that in others and exploit those flaws for our own selfish endeavors, which is to make money in the market, right?
You bring up so many great points, and I got to touch on a couple of them because, I've been in the markets for about 25 years now, since about 2001, and it actually has been a little while since I've thought about that, because I remember in my early days of trading thinking, what a self exploratory event this is, right? I mean, all the things I'm learning about myself, and all the flaws I'm seeing, and all the weaknesses that I have. And I thought, man, this stock market stuff is really just exposing me to that stuff. And so it's funny, I haven't really thought about that in quite a while. So I'm glad you bring that up. But another point that I'm glad you bring up is, the bar is not ridiculously high, right? About about the being less stupid. And so we've got a lot, we've got stuff we can work with there for sure.
Yeah, but you want to know
And
something? The worst decision makers are the smartest ones.
for
There's a
sure,
lot
because
there,
they have too much information.
it's the ego, first of all, because they're so smart. They've been told they're so smart their whole lives. So there's the ego aspect of it that's stronger. If you're told that you're smart your entire life, like, you're going to start to believe that that's true. And so there's the ego aspect of it that they can't overcome. And then also, because they're so smart, if they allocated so many hours, they're like, endowment, what is it, the endowment factor, whatever, where like you put more pride in like what you are, you know what I'm saying? Like they fall
Yeah,
victim
yeah.
to those things easily. So like those are really the most vulnerable, the smartest ones, believe it or not. The dumb ones be like, I don't know nothing, I'm just buy S&Ps and hope for the best.
Honestly, when you don't know what you don't know, sometimes you could be in a little bit of a better
Listen, if you're
situation.
out there listening and you don't know anything and you don't have time to trade, or you do trade and you want different strategies, you put, very simply, you put the same amount of money in the market that you can afford to set aside every month. You put the same amount in the S&P 500 every single month, right? What ends up happening is that you're going to be buying the highs, obviously, but you're also going to be buying the lows and everything in between. And if you understand compounding is, what is it? The most powerful. What do they say? Buffett say the most,
It's the most powerful force on the
the
planet or
eighth wonder
something. I
of the
mean,
world or something like that.
yeah.
Compounding, like something crazy, right? But yes. And when you see the chart of compound, it's like, wow. So then the wave, you see that chart of compounding money over time. If whenever the S&P is down 8% or more in a month, you put double the amount, right? And if you do that, the whip at the end is even wilder, right? So like that little adjustment there. And so, man, I'm telling you right now that, so if you know nothing and you don't want to know and you just like to do this for fun and that's a great, I do that. I have that. My wife and I, we have our retirement accounts and we got the kids' college fund. It's long only. That's it. There's nothing I could do there. I can't swing trade in my 529 plan or whatever. You know what I'm saying? So
Right.
like that's the strategy there. And then another strategies is more contrarian, where we're looking for unwinds and extremes in sentiment, really trying to take advantage of those vulnerabilities from humans making irrational decisions, many of them being incredibly intelligent and are responsible for billions of dollars, which fortunately for us, they can blow up real easy. And that means more money for us. So we're all for it. You know what I'm saying? And so that's what, so I think, another thing that I've learned over the years is very, how important multiple strategies is, when you understand, like, oh, there's no holy grail in the market. Actually there is, we know. Like we have the math, every additional uncorrelated strategy that you have, that you add, that you layer on, the lower your portfolio volatility and the faster that compounding thing we were talking about, that accelerates, right? With lower portfolio volatility. It's wild. So yes, there actually is a holy grail. So, I'm constantly, and then, he wrote about, it was like 15 strategies is like the idea. I'm not going to have 15 strategies, right? 4 or 5 at the most, right? 4 is good,
For sure.
5's good. After that, like, the 13th strategy, I know Ray Dalio has like a big fund and he could run a zillion strategies. Well, I'm not going to do that, right? 4 is good, 5's good. And you can see in the chart that it starts to drop off. Obviously, the 14th strategy that you layer on is not going to have as much of an impact as the second or the third, right?
For sure, for sure. And again, another interesting point you bring up, which is, multiple strategies, but also like, tell me your thoughts. What is your argument on why shouldn't everybody just dollar cost average, right? And buy some SPY and some QQQs every month. And what argument do us traders that are in and out of the market daily and weekly and monthly and so on? What's your take on that?
I don't think there's anything wrong with dollar cost averaging. I do that myself, like I just told you, right? I think that's great. That's one strategy, right? So I also have 2 houses that I own outright. So I have a ton of exposure to the ups and downs of the market between my long only portfolio that I don't have a choice. It has to be long only. I can't have like a short, a short bias in my 529, man. That doesn't make any sense, right? So, I'm long, I'm in. I got a ton of crypto. I own private equity. I own multiple businesses. Like, I'm in. So for me to be like, okay, I'm in, that's a lot of exposure. I am looking for additional layers that I could bring on. And I do that, right? And that's where trading strategies, right? So now I'm changing both, I'm going long, short, and changing the duration altogether, right? So I'm using a shorter term duration and a long short strategy, right? So that has nothing to do with any of the other stuff I own. And then so
Right.
you incorporate another strategy where, we have, I'm not saying you do it, but like we have an option strategy where we are selling strangles and we're collecting income, right? And it's not sexy. It's not gonna like make my year, but like it's just consistent, like and that has nothing to do with anything else that we're doing. And so we've got, where we're looking at futures positioning, where you're looking at treasury bonds, and you're looking at soybeans, and you're looking at coffee, and you're looking at silver and gold. And we're looking for extremes in positioning and unwinds between the commercial hedgers and the speculators, and really looking to capitalize on those unwinds. And that has nothing to do with my long only positions. We could be short S&Ps in that strategy, right? And it has nothing to do with what I'm doing over here. And so, right now I'm working on a bond strategy that I have not actually put any money in yet. Like, we're still tweaking it, but essentially what we're doing is we're taking all the bond ETFs, treasury bond ETFs. We haven't decided if we're going to add some of the like high yield bond ETFs. Like, I'm thinking the answer is going to be yes, and tips and stuff like that. Like, just put them all in there. We're still testing it, right? We're almost there, but the idea is to always be long bonds, just really changing the duration. That's where getting cute with the high yield and the EM bonds. Like, we haven't fully decided, but that's where we're headed, where we're always long bonds. It's just which ones. And then we're combining momentum and relative strength to make those decisions. So we're in the best ones when the best ones are working. And it's like, well, what's the best one? So you buy the best 2, right? Because that gets you. So that kind of helps solve for which ones do we pick? We pick the best 2, right? And then just kind of rebalance once a month. I don't have money in that strategy yet, but like that's next.
Yeah. So two questions come to mind. Number one, so when you say we, are you trading money for investors? Are you in a group running your own cash? How's your setup over there?
So I've got an army of analysts that we all work together, right? And are paid through a variety of different, avenues. We create content and we sell our publishing research, right? So like everything I'm doing in my portfolio. So I manage money for myself, and then through Trend Labs, I am sharing the trades that I'm doing in the portfolio, right? And we have 2 different strategies that we publish, and you can subscribe and watch or not, right? And we put out a bunch of free content on Stock Market TV. So we do a morning show in the morning, and there's a lot of free content. So that this is just what we do. And so the people that I work with are in there in the shows with us. Sam Gatlin and Jason Purrs and I options trader and Sean McLaughlin. I got my guys that I've been working with for years. Some of them are actually running strategies for me, right? Like on my behalf. Like, I'm monitoring the whole thing and I'm helping design the strategies, but they're doing the execution, right? For example. So, and then we just publish what we do. Our options trader Sean is publishing, sort of the options trades that he's putting on. Steve Straza is publishing, he's got his strategy where he's putting on options trades, and people subscribe to the breakout multiplier, which is great. People subscribe to myself with the divergent strategy, which is where the narrative is diverging from the price. Everybody thinks this, but this is happening. That's the trade. So that people sign up for our divergence portfolio and see that. And as we're developing a small cap strategy to publish now, where, my entire life I've been focusing more and more and more on smaller cap stocks, because I started as a formally trained technical analyst, right? Through the CMT Association. I have my CMT designation. My mentors were like classic technicians, some legends, Ralph Acampora and Luis Yamada, Alan Shaw. I mean, legends, right? So I learned from all of them in a very classic way. So I'm old school, top down, right? And then over the years, like 10, 15 years ago, like I would miss the little guys, How did I miss that 100% return? Oh, because I was looking at the, $200 billion one. I wasn't looking at the $1 billion one. So we built algorithms and systems so that it makes it very, very difficult for us to miss those opportunities. And what's great about small caps is, if you're managing, $50 billion, like it's hard for you to really play in that playground. For myself, I'm nowhere near that. I also only manage my own money. So having a small cap strategy really allows me to have an additional layer to my overall portfolio. Like I said, to, constantly striving to achieve that holy grail. Right.
There certainly is some major benefits in just trading your own money. You got so much more flexibility, and you can really kind of attach or attack so many more of these different strategies. So it sounds like you have quite a few approaches, quite a few kind of avenues to go down depending on market conditions. But if you had to kind of like narrow down, like what are like 2 or 3 things, indicators, metrics, things in the market that like really get your attention?
Yeah, I mean, listen, it starts with what pays us, right? The only thing that pays us is the prices of assets, right? So that's it. Nothing else pays us. We are trying to sell things at higher prices than where we buy them, period. And not necessarily in that order, right? But that's the idea. So let's start with that. We can all agree. It doesn't matter how you look at the markets. We can all agree that that's how we're going to make money, by selling things at higher prices than where we buy them, right? Facts only.
Yep.
Okay, so people forget that part, right? They're like, oh, stick to the process. Don't worry about the money. No, idiot. No, we're worried about the money. That we're here to make the money. I think Floyd Mayweather, they're like, oh, he's just fighting to win the money. Yeah, I'm a prize fighter. I fight to win the prize. Yeah, of course I'm doing it for the money. Yes, I'm doing it for the money. So if you forget, it's like, oh, but price is what you pay, but value is what you get. No, you idiot. That's not what happened at all. None of that is true. Right. So, sticking with that theme of like, we're trying to sell things at higher prices than where we buy them. If we know that to be true, then our analysis should both begin and end with the study of the behavior of the price of those assets, right? So there's a lot about the market that we don't know, particularly about the future, right? But there are certain things that we do know. Not a lot of things, but there are some things that we know. Number one, asset prices trend. We know asset prices are not random. We know they're not random, like the random walk hypothesis or whatever. Like it was just that. It was just a hypothesis and was proven wrong mathematically a million ways, right? There was a 6 Sigma event yesterday in silver, right? I mean, for that, you have a higher likelihood to get struck by lightning twice than for that to happen if markets were in fact efficient. So we know that they're not efficient. We know asset prices trend, the white papers, common sense. We know. Number one. Number two, the best assets outperform their alternatives. They're the best for a reason. They're outperforming their alternatives. So if you want to be long stocks, you want to be long stocks that are going up, because there's a much higher likelihood that they're going to keep going up than versus it just completely reversing, right? We know, we have the math. So you want to be in the direction. You don't want to be swimming against the tide. If you are constantly fighting trends, you're going to lose. I mean, it's just what it is. You want to increase your probabilities of success, don't you? Right? So rule number one, don't If you're gonna fight a trend, there's 3 rules, right? 3 rules to fighting trends. Rule number 1, don't do it. Don't do it. Do anything else. Go take a walk. Anything but fighting a trend. Okay, fine. Rule number 1. Rule number 2. If you decide to fight the trend, you better be sure. You better have such good information that you are fighting this trend, and there better not be a better trade. There better not be another opportunity. This has to be the best opportunity possible. You better be sure. Number 3, you better have very strict risk management procedures in place where what the market would have to do to invalidate your stupid idea of fighting the trend. You got to nail that down, because the market is going to do exactly that and prove you wrong. But you got to know quick at that you're being proved like that you are the idiot that you thought you were, right? So those are the 3 rules. Don't do it. If you do it, you better be sure. And number 3, you better nail what the market would have to do to invalidate that thesis. Okay, number 1, asset prices trend. We know. Volatility mean reverts, right? From high volatility comes down to low. From low complacency, you get spikes in volatility. Volatility mean reverts at both the market broader level as well as at the individual stock level. We know. We have the data. But here's the thing, Jared. Here's the thing. The humans, the lizard brains, right? We do the opposite. If something's trending higher, oh my God, it can't keep going up. It's got to go down. What goes up must come down. That's physics, right? Yeah, it's physics. It's not the market. The market doesn't care about your physics. There's no gravity in some of these stocks. There's just short sellers getting blown out. It has nothing to do with physics, right? So, I mean, you see the humans, and then it's going down. How much lower can it go? Oh, I'm a value investor now. Oh, yeah, you were a swing trader in the high-tech stocks a week ago. Now you're a value investor? All right, bro. Right? So now you get, the strategy swings, right? Going back, oh, now I'm over here. Now I'm a crypto expert. Global macro, the yield curve, right? Everybody goes through there. Listen, I've been there myself, so I'm speaking from experience.
Yeah.
So and then they're like, oh my God, the VIX is at 50. It's gonna go to 150 and never come down.
Why is the VIX the only one that nobody thinks will come back down? And it's the one that comes down the quickest, right? It always comes down the quickest.
Dude,
and
last year it crashed so bad, dude. Wow. Multiple times.
I know. The VIX was such a predictable trade last year, but it's interesting. So a couple of points to bring up, right? Because this is a timely discussion you bring up. One point that I have to go back on, which was great, right? Which, if you're going to fight the trend, if you got some mean reversion strategy that you're trying to jump on, make sure that there's not something better to trade. And when tech was just getting hammered, 2022, kind of everything was getting hammered, right? But there were stocks that were doing better than tech was doing worse, right?
Yeah,
and
financials, industrials.
Yeah, for example, I had crazy positions on industrials and material stocks that were just crushing it, right? They were just having a great run. 2021 is what I'm talking about. Everything just kind of started falling off a cliff, and then of course 2022 was gnarly. But instead of trying to short a $300 stock, what about buying a $30 stock that is ready to roll? Sector rotation, I think, is outside of most people's typical daily thought, right? I'm just going to trade this up and down. So I think that's such a great point. I'm glad you bring that up. But then that takes us to the next point of, okay, let's look at, I've just got my charts everywhere here, but let's look at, we've got all these earnings coming up, right? And we've seen basically, for lack of more creativity, we have all these Mag 7 stocks that really haven't done anything for 6 months, right? They've been range bound for 6 months, with the slight exception, Tesla maybe has done a little bit, but for the most part, we have this 6 month of nothingness, and then earnings are coming up this week and next week, and so on. Where are we taking these big cap, mega trender, crazy stocks from here? Tell me your thought process around those.
Yeah, you made a good point about sector rotation, right? It's the lifeblood of a bull market, right? Go study every bull market ever. You're going to see sector rotation. Everybody gets a turn, right? Or most of them get turns, right? And, you got leaders, and then, they lag for a while as they consolidate. They don't necessarily go down. They kind of go sideways, especially in healthy environments. And then others pick up the pace and take over leadership while those consolidate their gains that were the former leaders. And, that continues to rotate. So, you know, if we're going to have another leg higher in the market, right? So you kind of like reverse engineer what the next couple of quarters look like. 1, 2, 3 quarters looks like. And if you think that the market's going to go higher, then you reverse engineer what's the market going to have to do in order to accomplish that feat. So like over the last couple of years, like there've been times where it's like, all right, listen, financials and small caps are down near support. It's now or never. And if this bull market's going to go on, these things can't collapse. So, and we do think the market's going to go on. So buy small caps and financials, duh, right? And so you reverse engineer what the next 3 to 6 months looks like, because if you think that the market's going to go higher, these things can't go down. And if they can't go down, then they have to go up. So we might as well be long, right? There have been other times throughout the last few years. I remember, I think a couple summers ago, industrials were really struggling. Caterpillar looked terrible. And it's like, dude, we're so bullish and we think the market's going to go higher. Industrials just can't collapse here. So we have to buy Caterpillar because it can't go down anymore. It's got to go up. But JC, it looks terrible. I know. It does look terrible, but it can't go down anymore, because if it does, then bull market canceled. And none of us here think that the bull market is canceled. So we got to buy Caterpillar. And then it just rips in everybody's face. You know what I mean? But it's like, yes, I know it looks terrible, right? So, it's about understanding and putting the pieces of the puzzle together. And then it's really the positioning, right? The positioning this summer. You asked me about the Mag 7. You asked me about the Qs. By the way, the Mag 7 is $20 trillion in assets, right? And is a huge representative, right? Huge representative of the NASDAQ 100. This summer, you had the highest short interest by hedge funds and asset managers in the biggest long position in the futures market, in the NASDAQ 100, by asset managers and hedge funds ever, and the largest short position in the Russell 2000, small caps. Those same asset managers and hedge funds short the Russell 2000 this summer, long the NASDAQ 100. That trade was so extreme, and we have the public data. CFTC publishes it every Friday. You can see it. And so that's unsustainable. So if that's unsustainable, you take the other side. Do you have to short the Qs? No, but shit, got to buy the small caps. I mean, they've never been more short. This is, these are the worst investors of all time, asset managers and hedge funds, the speculators, particularly in the futures market. We have the data. These are the worst decision makers with the most amount of money at stake in the world. When they're at an extreme, we got to do the opposite. So if they all hate small caps, I mean, heck, I couldn't buy small caps fast enough, right? So then it's like, okay, well, which small caps? Well, that's what are small caps? You got a lot of regional banks, you got a lot of biotechs, you got a lot of technology, industrials. Which are the ones? At the time, last summer, they weren't the regional banks. They looked terrible. It was the biotechs, right? So I owned so many biotechs last year. You'd think that I was like in a lab coat in my basement, like I'm some kind of scientist or something. I don't know anything about these things. I know nothing about science or biotechnology or therapeutics. I can't even spell half those words. I have no idea. But man, the charts look great. The worst investors were super net short. So you're taking the other side of that, right? So so then now that trade has really unwound, right? So you asked me about the Mag 7. You asked me about technology. That's unwound. Can it, we're not in a reversion to the mean business, but in a reversion beyond the mean, so we can go the other way where now it's going to get super extreme to the small caps, and this is still going. But on an absolute basis, tech doesn't look bad. The Mag 7 don't look bad. They've been going sideways, right? On a relative basis, they look terrible. They're making new 8-9 month lows relative to S&Ps and small caps. I mean, just completely massively underperforming. But on an absolute basis, just really going sideways. So, we know asset prices trend. Consolidation should resolve in the direction of the underlying trend, which for technology and the Mag 7 is obviously up. So that would be perfectly normal and the much higher probability outcome. Now, with that said, I will warn, if that does not happen, if a bullish pattern, bullish behavior does not result in a positive outcome, that historically is tremendously bearish. And so we'll look for that. That'll be a lot of information about the broader markets. But, where we sit right here, right now, The higher probability outcome is that technology does break out. We do get new all-time highs. You do get some rotation out of some of the massive leaders that we've seen in like materials, small caps and micro caps, and some rotation back into these big ones, with all these earnings, that wouldn't be that surprising. So, now I'm always like trying to look around the corner, look a few steps ahead. If that doesn't happen, that is a big, big, big problem. Big problem.
Interesting. So that's your signal. We don't see some good positive earnings or some good reaction to the to
More
earnings.
so the reactions, right? I don't care about their numbers, right? They can lose all the money in the world, make all the money. I'm more interested in what the market thinks, right?
Right.
What I think doesn't matter at all. People are like, oh, the company missed earnings. No. The company didn't miss anything. The analysts are the ones who missed the earnings, right?
The company did what the company did.
What
right?
the company did. The company didn't miss earnings. These guys missed the earnings, right? So that's what people forget.
Man.
I'm more interested in the reaction.
It is interesting. I always kind of have tucked in the back of my head, specifically around earnings and the reaction to earnings and the reaction to certain types of news, right? I always say, as kind of an extra layer on how the market's reacting to certain stocks and news and financials about certain companies and so on, is it's interesting when good news stops producing a good result and when bad news stops producing a bad result.
That's right.
Right? And when neutral news starts producing the opposite of whatever the previous was, right?
Sure.
Bad news, going down. We've seen all these. We saw the tech stocks get, absolutely hammered a couple years ago, no matter what, right? They were punished for everything. And it's like, but then we started noticing, okay, some not good, but not bad news came out and there was a huge positive reaction, right? And these are kind of these interesting.
Less bad.
Less bad. Yes, we love less bad news in a bad news environment. And we love, less
the
good
rate
news.
Of change of bad.
That's right.
The delta derivative of badness.
On our bad news. Yeah.
That's right.
For all of us option traders out there, we got numbers for this stuff. And so it's super interesting. And it's going to be really interesting to see how some of this goes. And of course we could always layer a little bit of, hey, are these politicians reporting anything that they're buying and selling? There are insider criminals that I love to keep an eye on. But there's so many like little signals to look at. And one of the big signals, I have a chart sitting up right here that I've been looking at lately, and it's gold, and it's silver, and it's S&P, and it's Bitcoin, and it's Ethereum, right? And we're seeing just cryptos getting, I actually own the domain, and I've never put up a website, craptos.com, right? And I think I may need to put up a website right now just for maybe the next month or two. But we're seeing Bitcoin just getting absolutely murdered, right? We're seeing cryptos getting absolutely murdered. Is this and we're seeing gold and silver do something that nobody has seen gold and silver do for a really long time. So I love asking my guests this question because everybody has there's some similarities in their answers, but everyone has a very different take on why gold and silver is taking off and why cryptos are getting murdered. And I'm curious, what your take on that is.
Well, gold broke out of a historic base a couple of years ago, gave us a $5,000 target. We got there this week, as it turns out, great.
Mashed into it.
Made a lot of money in those stocks. Wish I owned more. Standard operating procedure. When you're right, you don't own enough. When you're wrong, you own too much. And this is a great example of like classic human behavior. Like there's nothing wrong with having those emotions, but I position size accordingly. I'm happy with the result. This is what I signed up for, right? So you have a process. So yes, obviously my emotions are like, you idiot, should have owned so much more, right? We could have bought so many more shares or had more gold miners. God, what an idiot. Yeah, of course I think that, right? But I think back to the position sizing, think back to the opportunities, that were there at the moment, all these things, more than doubled and then some. Great, fantastic. Next trade, there's other things going on, right? You move on to the next one. So you can't harp on that sort of thing. And then when you get something wrong and you position size accordingly and you lost some money, it's like, well, if I had a smaller position, I would have lost less. No.
A little bit big.
Yeah, and sometimes, listen, you go big and you take you're going to eat the risk. But if you want to hit that home run, you know what? And you swing and you miss, you eat that. You already, to me, I write the check and it's gone, right? It's like a VC check, right? Like an angel investment. It's gone, right?
Bye-bye. Bye-bye.
If you're gonna swing, and you want to take a swing, right? But just understand that you assume that that's a zero, and so that when it is a zero, you're good. You already came to terms with that, right? And then maybe it's not a zero, maybe it's a 15x, right? And then it's like, I'm such a genius. I'm the smartest guy in the world. 15x. If every trade I do goes 15x, I'll be a billionaire by next week. This will be easy, right?
I got this.
You gotta go
funny
through that
because
process, right? But just because you
it-
think these things doesn't make it bad. It just means you're human. That's okay. Just don't act on it.
just try to control yourself for sure. And it's such a funny thing because, obviously thanks to social media and the internet and our abilities to communicate with one another, we see so many of these people that have no experience in anything, right? I mean, I have people come to me constantly and they say, hey, I know you trade, show me some things, let me invest some money with you, whatever it may be. And inevitably it's a story like that, right? Somebody said, hey, everything got just hammered during COVID, right? And so I decided to just buy everything. I figured it would come back. Somebody who has no experience in anything, and they bought everything at the bottom of the COVID situation. They held on to it for 2 years, made, 10,000% on their money, right? Or somebody that bought Bitcoin forgetting they even owned it, and these kinds of things.
That
And
happened to
it
me.
is interesting. Did you get Bitcoin like in the dollars?
I must have been in like 200-300, something like that.
So here's the other question: did you fight your human nature?
I was given the Bitcoin, actually, technically. I wasn't smart enough to buy it. Somebody gave it to me.
But then that's the other thing, right? Because we can look back and say, well, what if you did buy it at $200? It wasn't given to you. You bought it. You said, hey, I'm putting my $200 into this, and of course, Bitcoin's at these crazy levels. What are the odds anybody's going to hold on to it that long, right? Do 1% of those buyers hang into Bitcoin until it hits 100,000, right? I mean, I was, I was still in my earlier stages of investing when 2008 hit, and I bought everything at the bottom of 2008, and everything tripled, and I thought I was the smartest guy in the world, and I got out of it, and then it continued to go another 9,000%, right? I should have just bought everything. I always like to say, like, if I could pick a time to get into a coma, that would have been like it. Like if I could have just bumped my head hard enough that it didn't cause too much damage and I was out for a year, it would have been so much better than me sitting here watching it, right? And so and that goes back to your earlier point, which I think is so interesting, of human nature and fighting those urges and those emotions. And I love when people say, well, we've got all this technology now, right? AI is going to replace humans in trading. And I always say, well, AI is just programmed by humans anyway. So don't we program into AI this?
You kidding me?
This
These things are blowing up left and right. They already are.
They already are. I mean, if they can do some basic math, that's a step in the right direction.
Listen, I'm in favor of anything that's going to help humans make poor decisions so that they could blow up faster and more frequently so that we could exploit that for our own selfish endeavors. Like, I'm all for it. Knock yourselves out. Go play with the toys. What could go wrong?
It helps our job. My 13-year-old daughter told me the other day, she said, Dad, I can never tell if you're really upset or you're really happy. I can never tell. And I said, my sweet daughter, I've been in the stock market for 2 decades plus. I don't have emotions anymore. I can't, because otherwise I got to go work at McDonald's. I make a great burger. I'll give them that. But like, you have to be able to see your way through this. And I love this discussion because, as markets go higher, and I think it's, I think between myself and those that I trust, and it was interesting to hear you say it as well, there's so much. I think the bearish market talk right now is similar to like the 2023, 2024 recession talk. Remember, everyone had a percentage. Oh, Jamie Dimon says there's an 80% chance of a recession in the next 2 years.
He's just making these numbers up. 80% chance.
Yeah. And I was always like, where are these numbers coming from? And of course, that's a huge bullish signal, right? And now we have all this bearish sentiment among the retail crowd. And that's got to be a bullish signal, right? It's again, but make sure you got the right trade. Make sure you're being cautious and careful. I looked at an interesting chart the other day. I don't know if you have they announced earnings already? WDC, Western Digital.
Oh yeah,
Did they announce already? Or is that tomorrow? I think that's tomorrow.
I'm not sure.
Let me just peek because I love a good chart here. So
Flat after hours. It's up 5% today. 252.
okay, but earnings, I got earnings as Thursday.
Got it.
Is that what you're seeing?
Yeah.
So we got earnings on Thursday,
January
and
29th, yeah, Thursday.
This is a stock that's gone up 750% in the last 10 months or so, right? Where do these guys go? And these are always very interesting. I love just watching the dialogue on these extremes versus the ones that, and I would say Western Digital, for example, is a very unsexy stock. Nobody's really excited about Western Digital, and here they have just exploded.
Shareholders have been.
Shareholders are feeling like they're king of the world right now, for sure.
Yep.
So on that note, what are some unsexy stocks that you're watching that you think have some great potential in this environment we're in?
Well, just to finish up on the conversation about the psychology, when you talk about like the your mindset, I was saying at silver at 50, it can't go any higher. At silver 75, like this thing is going to crash. And then so I was asked, well, JC, why haven't you sold any of your gold and silver stocks? It's because it hasn't hit our target yet, right? So you set a plan and you stick to the plan. What I think doesn't matter. Yeah, I would wake up in the morning, see silver up 5%. I was like, dude, this thing is not going to go higher, but I'm long, right? I'm long, but my emotions, just because I think that it can't go higher, the market doesn't care what I think, which is why the reason I hadn't sold is because it hasn't hit our target, which was our plan. And then what do you know? Then it just kept going higher beyond my belief. But there we are, fading our own emotions, right? I'm like, dude, there's zero chance. I was in Vegas a few months ago. I'm buying silver coins at like some like trade show. I'm like, dude, that's the top. That's the top. I'm buying silver coins in Vegas. That's the top. And it more than doubled after that. Like, so, you got to think about these things. And then so just the way to help overcome our lizard brain decision making is to have a plan, write it out, and then just stick to that. And then when the market does something and your alert goes off, it's like, well, what was I supposed to do when that happened? Well, you look at your trade plan and you're like, oh, I'm supposed to sell half. Great. Boop, boop.
So in your plan, how do you treat these seem like extenuating market circumstances? Does your plan have that flexibility, or do you really try to stick to it?
It's always, how many times I talk to people all day, every day. I've been doing it for decades. Every conversation starts the same way. JC, crazy market, huh? See, bro, crazy market, bro. Like, dude, are you watching this market? This market is crazy. Dude, every conversation starts the same way. And it's been happening for decades, no matter what the market's doing. It's always crazy. But it's not the market that's crazy. It's the humans that are driving all these prices. They are the crazy ones. The market is just showcasing just how irrational and crazy these humans are, right? That's what's crazy. And why is it so consistent? Because we don't change, right? The asset prices, the assets change, the decimalization, the evolution, you got the options, now you got the crypto and the this, and it's always an evolution. But there's one constant, us, right? So that's why, our poor decision-making process and our irrational decisions under stressful conditions is always going to be there. It always has. I collect magazines, financial magazines going back. I got stuff going back to the British bicycle bubble of the 1900s, the bowling bubble of the 60s. I got them all. 29 crash. I got so many magazine covers, and I was doing a project, so they're kind of taking over my office. Dude, I could tell you again and again and again, at Lowe's, you get all of these, magazines with bears on the cover of Newsweek and, all kinds of I got them all here. I'm not going to start pulling them out, but I got a whole bunch of them. Just take my word for it. And, at tops, the complacency at these tops, when you see Sam Bankman-Fried at the top of the crypto bubble, and then the Michael Saylor Forbes last January, like literally as MicroStrategy is starting their collapse. I mean, just perfect again and again and again. You see it. I mean, I have the evidence all over my office, and not to mention I've studied asset prices and participated in markets for over 2 decades. So I mean, I could tell you that the humans are always going to be there trying their best to screw it up. So we got to monitor that so that we can take advantage of it for ourselves.
It's an interesting point you bring up because, trading and the stock market, the financial markets are one of the few things that we have like very obvious historical evidence of decisions, right? If there is a chart for, I don't know, government votes, and I'm sure there are, right? But charts of decisions made in Washington, decisions made in your family, decisions made at school, right? And we'd be like, geez, there's some doozies there, right? But we all forget. We forget. I forgot that thing happened. But the market is this interesting thing that's always in front of us. Double-edged sword, right? There are there's some elements of looking back on a chart where you think, how did I not see that, right? How did I miss that, right? But there's this, I've always thought to myself, the charts have all the answers. We just have to have the right questions to ask, right? And we, any question we can ask, there's an answer related to these asset prices. And so it's a super interesting point you bring up, because we have this constant reminder of what good decisions look like and bad decisions look like, and these aggressive crashes off these highs, and these these little sneaky Carvanas that are down 99.9% and somehow have a 30,000% rally, or whatever Carvana ended up happening.
There's crazy short interest in that one, man. They overstayed their welcome in that one, boy. Woo-wee.
Did we learn nothing from the meme stocks?
Dude. And then all that is public data, right? All that short interest data on a per stock basis is comes out every 2 weeks. So we have algorithms that scrape all that data and show us where there's the most vulnerability for a short squeeze. So we're constantly monitoring that, looking for where shorts have overstayed their welcome. And these are not great companies historically. There's a reason why these guys are so short. These guys are really smart and they're right. But there comes a point where anybody who already knows that has already acted upon that. There's nobody left to sell. And what happens? Those shorts get blown out. So there's money to be made there. So we're looking for that. That's literally the divergent strategy that we incorporate. So, we're looking for those extremes, and that data is
you guys are trading the big shorted stocks. That's one of the approaches.
The big shorted stocks, the big shorted, commodities. So for example, going into last year, the dollar, the positioning was off the charts, right? The speculators, everybody's long dollar. The commercial hedgers were short. Commercial hedgers are long euro, long British pound, long Swissy. The speculators are short all of those. So you're looking for an unwind. You get a dollar break. What's the trade? I don't trade Forex markets. I just know that particular Forex market is incredibly extreme and in the process of potentially unwinding. Sure enough, first of the year, that thing really starts going on the other direction. I don't trade Forex. Like, yes, technically, could I have shorted the dollar index futures? Sure. This is not what I do, right? I'm not going to buy euro, right? I'm not going to do that either. So I'm thinking, okay, in the equities market, what's going to benefit the most? Well, international stocks, emerging markets, precious metals, gold, silver, platinum, palladium. Like, there are plenty of ways to take advantage of a weaker dollar in the equities market. So that's exactly what we did. So looking for that extreme in positioning, that's a macro squeeze is really what ended up happening last year, right? As that dollar unwound, but on the individual stock basis, we're 100% looking for the short interest and looking at the short ratio. So we look at the short ratio calculated by the number of shares that are short. You divide that by the average daily volume, and that gives you how many average days will it take all the shorts to cover. The more days, the more vulnerable it is for a short squeeze. So when that thing turns, forget about it. You got stocks that are 25, 30, 35 days to cover, and we're talking trading days. So that's like a month and a half to cover. I mean, these guys, if that thing starts moving, these guys are getting blown out. So just because everybody hates something doesn't mean we buy it. We wait for that trend to turn. We're using anchored VWAPs. We're using support and resistance to confirm that, yes, in fact, the shorts are indeed getting squeezed. right? Versus being vulnerable for a squeeze, because at the end of the day, these are terrible companies, right? There's a reason why there's so many shorts. And then also from a sector standpoint as well, the ETFs, the themes, right? So we have a thematic short. You got your individual shorts, you got your macro shorts, and then you got your thematic shorts, squeezes, I should say, where we're looking at the ETF, the short interest on the ETFs, particularly the most
Yeah.
liquid ones, and seeing again, where's the highest short interest, where's the highest short ratios, days to cover, and that theme, whether it be China, small caps this summer for sure, silver had its highest short interest ever in the SLV recently. Oil and gas, historic short interest in the oil and gas services, explorers and producers, the XLE itself, right? Massive short interest. These guys are getting blown out. It's fantastic, right? So when you see, biotechnology short interest was off the charts this year at the same time that the futures positioning was short small caps. So that's where combining those two comes in handy, where you're seeing historic short interest in small caps. And what's the biggest driver of small caps? Biotechnology, right? So when you see all the biotechnology crazy short interest, like it all adds up. So what do?
Yep.
You buy small caps, you buy biotechs, right? Small cap tech off the charts too.
That is great. I love that. Now, speaking of, and I don't want to keep you forever. I appreciate
No,
your
I
time. This has
appreciate
been
you.
great. We there's got to be something interesting, and I love asking everybody about this. We have this oil situation. Do you follow the energy markets any? The good old
Every day.
fashioned oil. What are you seeing in crude? And one reason that I look at this, I'm looking at earnings and so on, and I think ExxonMobil either reported yesterday or today, or they reported the next day or two. I was looking at it earlier. ExxonMobil has this like 3-year consolidation that
Yeah.
they just broke out of, right? In a pretty glorious fashion. XOM is I mean, they went into this channel end of 2022, bouncing around between basically 100 and 125 bucks, right?
Yep.
Pretty small channel for a stock this size. They just have this glorious breakout. It looks like earnings are later this week. So I look at that and I say, I haven't traded energy stocks in a little while. I'm, the oil and gas stocks are always kind of tricky, but I mean, do you see anything on crude? I mean, are you watching that futures market? What are your thoughts there?
100%. I mean, listen, sector rotation is the lifeblood of a bull market. Energy simply has not been participating. And, if everyone's going to get a turn, this would be a logical place for that to happen. When you look at the energy indexes themselves, the stock market index like the XLE, we're still at the same levels we were in 2008. That was, 18 years ago, which is wild, right? During the great financial crisis, or like the beginning of it. That was the peak in that summer. It was one of the last ones to peak. So, that's number one. Number two, so the upside is like insane, right? Because the base is so big. The bigger the base, the higher in space. That's number one. Number two, from a commodity super cycle standpoint, all the evidence has suggested, hence our $5,000 target in gold and 120 in silver, right? Those were the targets. These are huge targets. I didn't think we'd get there this fast. I'm not gonna lie. But one of the interesting parts about commodity super cycle is they don't last a few years. They tend to last a decade or more. So are you going to bet that this is going to be the shortest one ever? I'm not going to do that, right? You're welcome to. This is America. You can do anything you want. I'm not going to do that, right? So, and then when you look and you study these commodity super cycles, gold tends to go first, and silver, and then copper, and you get those industrial metals doing their thing. So there were times in this cycle where gold is doing its thing. I'm like, man, where's silver? Why isn't silver doing this? And then, okay, there's silver, right? Slowly but surely, and then all at once. And then it's like, well, precious metals are doing well. Why isn't copper going? Why isn't copper going? Well, there goes copper. And we found ourselves, a month ago or so, 2 months ago, being like, well, if gold's going and copper's going, where's energy? That's the next logical one. How come energy's not going? Well, now you're starting to see it up 10% so far year to date, right? Not bad, right? So when you see energy moving, or 12% year to date or something like that now, when you see that happening, to me, it's confirming that now, yes, in fact, that cycle is repeating, and gold went first and silver and then copper and now energy. Like that's how it was all those other cycles. So should it be a surprise that we're seeing it this time? No, and actually we're betting on that. Right. So then it's like, okay, well, what do? Do you buy oil futures? Do you buy ExxonMobil? I think it can be any of those. If you're a futures trader, yeah, sure, buy oil futures. I'm not a futures trader, so I am buying, small cap oil and gas stocks showing relative strength. I'm trying to buy the best ones. ExxonMobil is one of those from a mega cap standpoint. When you look at smaller cap stocks, you look at oil services. You got a lot of names in there. We got in Halliburton last week, actually, made new highs today. Look at Imperial Oil in Canada. That's probably the best oil and gas stock in the world, right?
That's a goodie. There's some good ones. There's some interesting looking charts. DVN's kind of been on my radar a little bit. That's always a good one, but I love that because I think it is, as I talk to people, right? I love to just get like the word on the streets, right? And I talk to people and nobody is talking about oil and gas, right?
Yeah.
It is not in the vocabulary, recent vocabulary of anybody.
No, don't worry. Wind energy is going to solve all our problems. Don't worry.
Wind energy will be great. And also, all the energy is going to be used up on data centers, right? And a Tesla here and there. And so, I mean, I don't know how many Tesla, I don't know what the market penetration looks like for EVs, but it's got to be low. I have like 7 cars and they all drink a lot of gas. And so, I mean, it's that kind of situation where people forget that we're probably a long way from not needing oil. I don't know, a couple of decades possibly. And here is this forgotten trade. And I love forgotten trades because they always, the unsexy things, right? I made a killing on steel and aluminum and copper stocks a few years ago. And,
sure.
These companies that people just don't love, there's not a lot of commitment to them, but they take off
their
and run,
recency
right?
bias. They can't overcome their recency bias. That's the problem. But if you can, and I can, and are currently am doing, I am overcoming my recency bias because I was trading those quantum stocks and I was ignoring the energy. Yeah. So what? Oh, you're a growth trader? Because why? Because growth stocks have done well. Oh, you only trade American stocks? Why? Because American stocks have done so. People's recency bias is off the chart. So if you can overcome that, and I was there in the 2000s where energy stocks were doing well, so I know all these names already, right? So that probably helps. That people are like the chart trading in 2015. It's like anything that happened before 2015 didn't happen, right? Well, fortunately I was there over 10 years.
Was there a world
2015.
prior to 2015? Was that a thing? But it is funny. It goes back to that recency bias or that trader mentality of ego, right? Where we have to say, I don't care about it, so it doesn't matter, right?
Yep.
I have been in the markets for 2+ decades as well, and I still think I don't like these sectors, and I'll miss huge moves. And I think, and I still, and it's not that I won't make any money on something else, but I'll think, even as long as I've been at it, I have to remind myself, my thoughts are not the most important part of this equation here. It's doing the research and it's finding the great trades. And so
these consumer staples can be very boring, and sometimes they're not. And you got to be YOLO in Procter and Gamble. Why the hell? There's a time and a place.
When was the last time you didn't need toilet paper? I mean, let's go. Let's buy these stocks. Let's
I'm
rock and roll.
Booze, cigarettes, toilet paper, paper towels, condoms, the whole thing, right? Staples.
We're gonna need these. I mean, what's the is it MO that I have not traded
Church
forever?
and Dwight, Procter and Gamble, like these are all your classics.
Man, some of these have just ripped. They've just gone crazy, and so there's some goodies, and we have some great examples and some good reminders. But thank you a million for joining us on the podcast.
Sure.
I love your take on the process, on how you approach the market, and it was super interesting. So thanks for being on. Tell people where they can follow you, where they can learn more about what you're doing, and keep an eye on what you're already doing.
For sure. Just follow me, JC Parets X on Twitter, and follow me at trendlabs.com. You can read my newsletter there. I send out every morning called Everybody's Wrong, because we are constantly looking for opportunities to take advantage of somewhere where everybody's wrong. Everybody's always wrong somewhere in the market, right? And we're in there every single day. I'm talking about where I think everybody's wrong. And we get a lot of feedback. We like to have a lot of fun with it. So I hope you enjoy that. Trendlabs.com.
Oh, that's awesome. That's awesome. We'll definitely post all the links to everything below this video. So thanks for being on with us. That was great stuff. And we hope to have you on again in the future. Thanks, JC.
Reach out.
Take care.
All right. Thank you, Jared.